All right, give me 1 second. I'm going to be going over the active, whatever, the tape reading course, Wyckoff's tape reading course. Many folks don't even know this exists, but it does. It's called Division 2, so feel free to go and get it. You could probably buy it from Wyckoff SMI. If they don't have it, check online. Whatever the case is, Wyckoff was known to devise a Wyckoff wave. All right. Now, some folks think that Wyckoff wave can requires 5 leading stocks or 7 leading stocks and sum them up, and that's the Wyckoff wave. But don't realize that it can be applied on any stock, any commodity. It doesn't need to be 5 leading stocks or 7 leading stocks. You can apply it on the ES or crude or SPY or whatever. So I'll be going over that course and starting over here. Before this, it's just what is it? It's just other stuff like just talking in the beginning. Um, so we're not going to go over all the stuff. It's judging the immediate trend. What you need to know is what I'm going to go over, and what you need to know is that it's used to judge trend. Is the immediate trend up, down, sideways? Notice he uses the term immediate trend. Why? Because a counter trend can also be an immediate trend. A pullback on a higher time frame can be an immediate trend on a lower time frame. So this method is catching the immediate trend. Now what he says about this, it happens 1 to 3 times per day. I see it happening 1 to 3 times per day. Like 3 times per day can happen on a 1 minute. But Wyckoff mentions using a 5 minute chart. He basically says use a 5 minute chart. So supposed to use a 5 minute chart, but 3 times a day when the volatility is good. If it's not, it's basically one time a day maybe. And on a 1 minute chart though, you can get like 3 turns regularly. Alright, but use a 5 minute. Alright, so for this purpose, we use a wave chart price of 5 of the most active leading stocks. He did this because in that day you didn't have the ES futures, you didn't have the SPY. The prices of these are added together and plotted on a sheet of paper. Obviously, you're going to use a chart. And he's saying that all of these are alternate buying and selling waves. We judge the strength and weakness of the market by the distance. So how do you judge the market's strength and or weakness? That's the first question. And he answers, we judge the strength and weakness of the market by the distance. It's basically the price going up. So distance in points and fractions recorded by this wave. So you judge the strength by how much it goes up or down. Goes up a lot, then you judge it that it's strong. If it goes down, it's weak, right? But the quantity of how much it goes up or down is the factor, is what we're looking at. Okay, so distance in points going up or down tell you strength and weakness. We combine this with the length of time. Again, time. What does he mean? How long does it take to go up or down? It went up 5 points in 15 minutes, or did it go 5 points in 25 minutes? If it went up 5 points in 15 minutes, it's stronger because it took less time, because there's more quote-unquote speed. If it take 25 minutes to go up 5 points, it's not as fast. It's not as much speed. So you take the time and you take the distance. So this is price and time. So you combine the price distance that the market goes up combined with time that it takes for each wave to go up or down. In studying, quote, distance and duration, meaning price and time of each wave, if the buying waves are longer in duration and travel further than the selling waves, we get the indication that the immediate trend is upward. All he's saying is, okay, it goes up more than it goes down, and for a longer period, then the trend is up. Why? Because more price, more time up, then price and time down, therefore the trend is up. Bulls are stronger than the bears. 5 points up 15 minutes versus 2 points down 5 minutes. Where is more price and time? On the upside. Therefore the bulls are stronger. Therefore the trend is up. That's all it is. If the selling waves exceed the buying waves in time and distance, the immediate trend is down. Whenever the buying and selling waves seem to offset each other and the material strength and the weakness is indicated, the immediate trend is in doubt. All it's saying is if the size of the waves equal each other, then there's no uptrend, no downtrend, it's a sideways trend. And our position should be neutral. Select the 5 leading stocks. I mean, you really should use leading stocks because they influence the rest of the market. That's why. So strong hands will use those big stocks, like whatever the leading stock, whatever the leading stocks are, to influence the rest of the market. You can see, today, just take a Amazon or whatever and see how, if it goes up or down, and the impact it has on the rest of the market. Anyway, add the price of their first sales, etc., etc. This is how to do it properly, and you can just, if you want to build the Wyckoff wave, you can do so by just taking those leading stocks, and there's many applications. Even Thinkorswims allows you to just add them up. All you have to do is take the different symbols, put a plus sign. Like if you do Apple plus Amazon plus Google plus whatever, Thinkorswim will add them up and build it for you. But if you're using something more sophisticated, it's probably better. Anyway, so that's all he's talking about. Or you can just look at the ES and the NASDAQ. Next watch for either an upward or downward swing to exhaust itself. Whether it seems to stop, put a dot. If the market then reverses its direction, this proves that the position of the dot is right. If it goes the other way, then change the dot until you figure out how to judge a turning point. Okay? Then watch the wave until it seems to come to an end. Please place the dot. So he's just talking about hand charting, placing dots, but obviously you just use zigzag indicator. You don't have to put any dot. But you do have to judge the turning point. The market will confirm or contradict your estimate of that turning point, and on until through thoroughly familiar with judging and recording the start and end of the waves. The immediate trend is indicated. When is the immediate trend indicated? We just talked about the immediate trend. All you need is one up wave and one down wave have completed. So when the day starts and you have one up wave and one down wave, and the up wave is greater than the down wave significantly, not that it's a little bit, because a little bit is not really that good. But when you have one up wave and one down wave at the beginning, open, you'll see that trend is up. You then know which side the most power. Is it buying or selling? How do you know? You just take the time and distance and then compare it to the pullback and take the time and the distance. If the up waves are greater in time and distance than the down waves, up waves have more power. They have more power, buying power and lasting power. Buying power meaning distance, lasting power meaning time. All you have to do is go with that side, but you must always be on the lookout for the change in trend, because this happens all the time, and also false moves. We'll see this a lot in the morning. So you must always be on the lookout for a change in trend of this immediate trend. It's likely to change direction from 1 to 3 times in a session. This is very important because this is what happens depending on the volatility. This is what happens. So this is how many trades they should be taking, 1 to 3 per day. That's what he's saying. because you're always trading with a trend. So changes up to 1 to 3 times, you trade 1 to 3 times. This is how you detect a change. This is very important here. How do you detect that change in trend from up to down and down to up, which is supposed to happen 1 to 3 times a day? In an uptrend, when the selling waves begin to increase in time and distance, or the buying waves shorten, either or both will indicate a change in the immediate trend. So, two criteria. What is it? In an uptrend, when the selling waves begin to get bigger, begin to increase in time and distance, meaning lasting power and selling pressure or selling power, or the buying waves shorten. Now I'll give plenty of examples of this later. I'll show you how the market turned. Plenty of examples. All it's very simple. It just shortens. The buying waves shorten in time and distance, right? But what he's not saying here is typically when those buying waves shorten, before that they shorten, there's usually a strong wave. So imagine almost a climactic move up, and then right after it another attempt to take out the high, which does take out the high, but the wave is very small. That is the shortening of the thrust. So it usually happens. I know he's saying that, okay, buying waves shorten, but typically what I've seen is it happens after an exhaustive move up. Then there's another attempt to go higher again, which is very small relative to the prior up wave, and that really indicates a loss of momentum, and the market is ready to turn. What it really means is that on the prior wave up, the bulls exhausted themselves. And that's it. So how do you judge a change in trend? In an uptrend, you're looking for two things. One, the selling waves are increasing, and two, the buying waves shorten. Either or both. Usually they're both together. What I see is they just, usually there's shortening of the thrust, and then there's a selling wave, which is change of behavior, or there's a climax, and then there's a change of behavior in the downside, and then the pullback is very short, and bang, change in trend. So, and this happens on intraday as well as daily charts. I can show up plenty of examples later on, and how to judge them and how to trade them. Where was I? You'd look for... Alright, so he explains how to detect a change in trend. I already went over that. And apply the same reasoning to a downtrend. What reasoning to a downtrend? If you have a downtrend and the buying waves increase in time and distance, and or the selling waves shorten, you get a change in trend. Okay? But even when you have a change in trend, you always have to be lookout for another change in trend. This is also expected because many times you will have that. In other words, you have they can follow each other, right? So you must always expect a change in trend, and you're constantly taking a look at the time and distance of the up waves and down waves to figure it out. Watch. So basically you want to see this behavior at a level that's important. So just ice and creek or whatever, the test of breakouts, that's where you're going to see this kind of behavior be helpful. Apply the same. Watch closely for the changes for they tell you when to buy. So when do you buy? It's another question. Now he's not being that explicit, but he's saying it in the way he says it, which is watch closely for these things because they tell you when to buy and when to sell. So if someone asks you, when do you fucking buy and sell? You do it when there's a change in trend. Change in what trend? The immediate trend. Alright? When do you go long or short? When to close your present trade and reverse your position. When do you close your present trade? When there's a change in the immediate trend. When do you buy or sell? When there's a change in immediate trend. When you reverse your position, when there's a change in the immediate trend. When is there a change in the immediate trend? When the up waves shorten and the down waves increase in time and distance in an uptrend, or in the downtrend when the down waves shorten and the up waves increase in time and distance. That's when you do what? You take a position going long or short, you exit the position, or you reverse your position. And that's what this whole thing is saying. Remember, you have nothing to do with other trends of the market. Again, when you trade the immediate trend, you don't care about the longer term trend. You don't care about other trends on other charts. You are trading the immediate trend. Now, what he's not saying here is that even when you're trading immediate trend and their counter trends, you really should be aware of whether it's a counter trend and whether there's a level, because that immediate trend can sucker in a lot of people, and all it'll do is it'll test the breakdown or the breakout and reverse right away. So you really should know whether that immediate trend is, even though he's saying over here it doesn't have anything, this is what you're focusing on and not other trends, you should know what the other trends are on other time frames as well as the levels. Why? Because buyers and sellers are at those levels, and when they're tagged, they will come in. So, however, for the purposes of what he's saying so far, you just trade the immediate trend. If it's turning down, you get out and you take the reverse. Alright, so his opinion is you have nothing to do with the other trends of the market. I know for a fact, you better know other trends of the market and the level you're at before you take it. And either the long trend or the immediate swings. So there's long-term trend and there's immediate swings of 10 to 30 points. The latter swings are the basis of the first division of this course. And so he's just saying that those swing trading, swing trading is covered in the first part of his course. He teaches you how to swing trade. Alright, when he looks at the point and figure and he sees that, oh, okay, this is the relative strength of this stock. Are you trading with the market? Yes. It's their cause, and there's a nice point and figure, and does it break the stride and all that? And then is the sector up and stuff like that. So that all is the basis of swing trading, which is doing what? Going for this much, 10 to 30 points. The latter swings are the basis of the first division of this course. Trading for such swings is entirely different proposition regarding less time and attention, because obviously day trading requires more time and attention, which is a good point, because you have to sit and wait all day for 1 to 3 changes in trend when you're day trading. And you have to pay attention, meaning look at the chart as the bar goes tick, 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 tick. Oh, and it's sometimes really exhausting. But having at its objective larger profits, so he's talking about swing trading has more profits or larger profits, meaning 10, 20, 30 points, and using 2 to 3 point stops. So worst case is 3 to 10, which is a 1 to 3. Best case is 2 to 30, which is 1 to 15. Risk reward. More detailed instruction regarding the above wave chart will be found in the division of this course. More detailed instruction regarding the above wave chart will be found. Okay. Although, and he's talking about, in the first division, there's a chapter on the wave chart. And anyway, although the buying and selling waves may be sufficient on certain days to carry the market in a certain direction, this does not mean that it will continue to do so the next day, and it does not mean that you should carry it. So he's just saying it's day trading. Alright. Why? Because you're trading with immediate trend, and it could be a counter trend, and you're going to get handed over. Especially if the market closes and you go away, and then get up in the morning and see a gap. So another point he's saying is wave chart teaches tape reading. After you've used it for a while, you won't really need to because your eyes will pick up the waves. So this is very important because one of the things that you need to know as a Wyckoff style trader is tape reading. So how do you do that? There's two ways that Wyckoff talks about to learn tape reading. One is this wave chart. Second is when he starts using the point and figure with volume, meaning volume in the X's and O's. So he takes out the X and O's, and in the box he has actual volume prints. So that this wave is, I think, easier, but I mean that's the second way to do it. And a lot of charting programs will not allow you to create that. But almost all charting programs allow you to have a zigzag indicator along with the volume or time and price. Price, they usually have price and volume. Anyway, these happenings that you are required to plot on the wave chart after you have gone from the first stop to the first step to the second, you will after a long time begin to develop intuition. This very critical point. Do not alright, there's a lot of vendors and stuff, like, I don't mean to bash them, but for some reason, if you understand this method, right, and you have some kind of like rules in your head, you know when to apply them as the markets are forming. But if you take those same rules and you code them, they won't work. And because if then conditions on markets don't work. There's too much information in the background since the trend started to the point where it's about to turn, which all of that needs to be factored in. So this is kind of weird, but mechanical rules do not work in the market. And good luck with using any indicator, because they will not work. Okay, unless the market is in a crazy uptrend and it keeps on giving buy signals. In that case it works. But in normal conditions, for some reason rules break. They just don't work. But if those same rules are in your head and you're applying judgment, they do work. That, I don't know why that is, but that's the case. And this is the whole point, because as you're using the wave chart, it's actually a tool for you to develop intuition. This is what people don't understand. They think that the wave chart in itself is the answer, meaning you need a wave chart of leaders that will somehow lead the market. And if you have that, and you have a tape reading chart, you can then, put really good trades on because it's telling you based on the volume that it's going up. Now, that's not the case. The case is it's through the experience of using these tools where you yourself become the indicator, and by developing intuition. That intuition is the indicator. That's what's a little crazy, but that's what happens. By which you will know in an instant. It is the intuition by which you will know in an instant when a change in the immediate trend is coming, just as, can't read this, champion knows how to hit a golf ball without thinking of all the different motions necessary to doing it correctly. But do not abandon the wave chart. So how do you know when to trade? Is it based on a spring and an upthrust by itself in a mechanical way? Is it based on a big vertical bar? Is it based on a breakout or breakdown? These are all pieces of information that will go into your mind where you have experience and intuition, which will then tell you yes, go long, or no, go short. The 5 leaders should always represent the market. Alright, good. This is important. Selection of these leaders. If you are developing the wave chart with leaders, he gives an example of how to select them. You select them by observing, by comparing them to the pulling power of 5 horses, meaning a group of horses. So that's like the analogy that he's giving, because the leaders, what he means by that is that they lead the market, meaning they can be used to influence the rest of the market. Alright, if they go up, the rest of the market goes up. If they go down, the rest of the market goes down. So these leaders are like horses that are pulling the market forward. If you were driving such a group, if one of the horses is lagging, you remove it. Just like the stock. If one of the stocks is lagging, you remove it. Alright? Apply this reasoning to keep your 5 leaders among the most representative of the stocks of the market in their ability to what? Influence. That's how you know. So the idea here is what is the criteria to select the leaders? The criteria is, can they influence the rest of the market? Can they influence their sector? You don't just take a stock because it's in this average. You don't just take a stock because it's an expensive stock. You don't just take a stock because it's on, it's traded a lot or it's heavy volume. You take the stock based on the criteria of its ability to influence the rest of the market. That's what we mean by when we say leaders. Alright? And he's saying that keep weighing this from day to day. So some wave charts I've seen on some sites where they say, I really think they were done 10 years ago. So do you think that's going to work today? No. What, you're supposed to weigh them and get the leaders of the day. Weed out the poor ones and use the latest ones. The wave chart of the previous day should be before you when the market opens. All he's saying is know the shit that happened in the last session. That's it. Okay, because it's like a continuous picture, not just independent picture. And that helps you with the intuition. So that also will help you, because if the market broke yesterday, like, you should know that level. I don't know what to do with this. Anyway, so it goes up, down, up, down, up, down, opens here. So this is yesterday. Here on the left hand side, then you have the close and then open and close and then open, then goes down, then closes, then opens. So all he's doing is putting those together from the close of yesterday to the open of today. That's all it is. Alright, and these were so just get yourself 5 most influential market stocks and put them in your charting platform, and bang, create the Wyckoff wave. Put a zigzag on it and use price and time as your labels, and at the bottom you should have like some type of wave volume. Alright, I'm done. I'm going to go over the buying and selling waves tomorrow. Thanks.